this class with it. I thought we would be able to. The more I looked at it, it was kind of there's quite a bit there. So anyway. Oh, here we go. So this chapter 10 handout. So I'm going to do the bank reconciliation. And the purpose of the bank reconciliation the purpose of the bank reconciliation is to determine the correct cash balance for the business. It can also be used to find fraud. But I mean, for the most part, it's determine the correct cash balance. How much cash do we actually have? And you guys may have already been doing this, you may do it on your own. So what we're going to do is we're going to do the we do the bank balance, and we're going to compare it to the book balance. So this is what, so 2,400 is what the bank says we have. And according to our books, we have 1950. Now there's a whole bunch of stuff in here, and some of it will go on the bank side, some of it will go on the book side. And basically what we're trying to do is, obviously because they have two different balances, there's information that somebody's not getting, right? I mean, if everyone had all the information, they'd have exactly the same amount as we have on our books. But someone's not getting the information, or they're not getting it on, timely enough to do put it in either the bank statement or into the books. So the question is, well, which side needs to be updated? Because clearly somebody has information and clearly somebody doesn't. That's why we have this, discrepancy. And basically, the stuff that shows up on the bank statement that you get from the bank, on usually the end of the month, they'll send it to you. You get it on the 3rd or 4th or whatever day you get it. Electronically, you can get it immediately. But anyway, that information is probably a lot of stuff you don't have, right? You don't know what the bank fee is. They may charge for this or that or whatever it is. And so a lot of times you get the stuff that the business gets is from the bank statement. But there's also a lot of stuff that the bank doesn't know. If I write a check on, March 31st and send it out, the bank doesn't know that. They won't know that for a week. Someone else will get the check and then they'll go to the bank and they'll deposit, and then it has to clear their bank. And so there's a delay. So there's things that the bank knows on the bank statement that we don't know. And vice versa. There's things that we know. We know we wrote this check. The bank doesn't know. So it's sort of updating the side that doesn't know. Right? So that's kind of the whole idea behind this. Kind of getting everybody the information they need, basically. Okay, deposit in transit. These. Deposit in transit is when you make a deposit near the end of the month. Do I give a date here? I don't give a date. Who made this stupid problem? All right, well, anyway. Oh, January 1st. Okay. So if you made a deposit, say on January 21st or January 31st, the bank probably doesn't know about that. Maybe they won't have it, especially if you did late in the day. So you made this deposit. We know we made the deposit. The bank just doesn't know. So which side are we gonna correct? The book side or the bank side?
The bank side.
Bank side. Okay, so deposit and transit. Oh, I should ask this, Adam, we're gonna add it in. We know we made a deposit. The bank's probably not gonna count until the next day or maybe 2 days, depending on what's in. All right. So this will go on the bank side. Okay, electronic fund payments and receipts. Now, these are electronically done from your account. There are no checks for this. You're not writing a check. It's automatically taken out of your account or put into your account. So when are we going to find out about those?
They'll have to be adjusted on the book side.
Yeah, probably on the bank statement, right? I mean, they're going to say which one, what came and what didn't. And even if you're expecting it, doesn't necessarily mean it happened. So we would have to adjust the book side. Okay, so let's see. The EFT receipts, kind of revenue account. It's gonna be annoying if I keep doing it all. And the payments are obviously going to be okay. NSF check. Now this is a customer's check. This isn't our check. We didn't write this check. This is a customer's check. So customer handed us a check for 240. We thought it was good. We may even have checked to see if it was good. And anyway, we deposited it thinking it was good, and it comes back that it's not sufficient funds. So which side are we going to have to correct?
The book side.
Yep. Yeah. The bank, they figured out that this check isn't good, so we have to correct our side, and this would be, oh wait, I didn't put the, hold on, I didn't finish either of these. Let's try this again, Mark. So this would be $50. The payment would be minus 120. NSF check would be minus 240. Okay, outstanding checks. We wrote some checks, and we mailed them out near the end of the month.
And the bank side.
Yep, good. The bank side is going to be. We know we wrote the checks. The bank doesn't know yet. Okay, bank fees.
You're gonna adjust the book side.
Yeah, and notice something about bank fees is that there is no check written for those. They just take it out of your account. No collection of income. This one's a little bit, I don't know how often it happens, but yeah, basically what's a note? A note is like a check. It's sort of like a post-dated check. The same kind of legalese stuff applies to it. If you sign a note, like if you sign a check, that means it's guaranteed that you sign that check, whatever is written on that check, your name is on it, it must be paid. All right, so that's what a check is, and it's paid upon demand. A note is similar, with two distinctions. First of all, it's sort of like a post-dated check. It's usually sometime in the future. So it'd be a note payable in 30 days, 90 days, 3 months, whatever it is, sometime in the future. And usually there's interest involved in it. Now, let's say you're running a bicycle shop and somebody says, can I give you a note? Sure, it's just like giving a check, whatever, you know, maybe you have a relationship with this person, whatever it is. You say, take this note. Well, you're in the business of selling bicycles, you're not really in the business of collecting notes. But a bank is. Banks, they collect notes all the time. So you might give it to the bank, and for a fee, they'll collect the note for you. So that's kind of what the what this note collection thing is. Now, when are you going to find out about the collection of the note?
On the bank statement,
So which side do we adjust?
the book.
Yep. And interest income.
You're gonna adjust the book side.
Yeah, probably same thing. You probably figured it out on the, when you get the bank statement, they'll tell you what interest you have. Oops, that's nice, low income. All right, 5. Okay, now we should, well, you have a lot of space there. I'm not sure why I did that, but I'm gonna lighten the load here a little bit. Okay, so we'll come up with a corrected balance. And the corrected balance should be on both sides, it should be the same. You know, we've corrected the bank side and we've corrected the book side, and they should come out to be the same. Hopefully the side comes up the same.
It's gonna be 2150 on both sides.
Okay, thank you. Sure. So this will be the corrected balance. So these two sides should equal, because there really is one corrected balance. Now, here's a couple things, you know, about this. First of all, you don't have 1950 in the bank, you have 2115. But also, this book balance isn't going to magically come out to 2115. You're going to make journal entries for all the stuff on this book side. The reason why that's important is that the correct cash will not be on their books unless they do these journal entries off of the bank reconciliation. And that's why the bank reconciliation is generally done by, you know, the accounting department, because these are the journal entries that are going to be made. So for instance, this EFT receipts for revenue $50. So this would be what, cash 50 and revenues 50. Note collection would be cash 500. And notice that, you know, the notes receivable would be misstated too. And so for all these, you would have, you know, a journal entry. Be 5. Oops. And same thing down here, EFT payment rent, so you'd have what, rent expense? You guys get the idea. I'm gonna belabor the but anyway, so for each one of these, you're, oh wait, NSF check's an interesting one. Need more room though. What do you do with the NSF check?
You gotta pull it out of accounts receivables.
Yes, good. You can put a custody on the books because you're not going to forget about it. You're going to call them up and say, hey, your check bounced and come down here and buy it from us, basically. But you have to correct your cash for it because you don't have that cash. Oops. That one's not as obvious as some of the other ones. I don't know, bank fee, some kind of expense, miscellaneous expense, bank fee expense, something like that. Whatever you put it in as. So these journal entries, though, will not be made unless they your cash won't be correct unless they make these journal entries. So these journal entries are one of the big reasons why you do the bank reconciliation. I was on an audit where the controls they weren't doing their bank reconciliations. And the controller said the stupidest thing. He said, well, the bank always has more money in it than we do. Okay. Anyway, to know how much cash you have and to update your accounts, notes, and all this kind of stuff, expenses, you need to do the bank reconciliation. Question on that? A lot of times, like if you have accounting software, the accounting software, a lot of times nowadays, if you do everything on the accounting software, I should say, a lot of times it's already in there and you can do them fairly quickly. And may have one or two things you have to adjust, but a lot of times the accounting software, if you run everything through the software, you can do these fairly quickly. All right. This is a bona fide CPA exam bank reconciliation. And so it's a little bit more involved than what we just did. And basically, here's the March bank reconciliation. We'll make that yellow. And here is the April results. And they're going to ask you to do bank reconciliation for it. Now, the one thing that we have to figure out, it'll be on this next page here, are the deposits in transit and the outstanding checks. And this is actually the hard part about this. The rest of it's not too bad. But finding out the deposits in transit. So here, I'm gonna take this off. I need to use these colors. Let's say so deposits in transit. Okay, so notice from the bank reconciliation before, we had deposits in transit in March. Make those blue. Okay. Now, when is the bank going to put those on their in the bank statement, basically in our account in the bank? In March?
So wouldn't it be in April? So you would deduct the 3,500 from the 8,400 deposits.
Close. This 8,400 are those are the new deposits for April. So if they were to collect all the deposits, it would be the 8,400 plus the 3,500 from previous. These are the March deposits. These were in March. Right? So these are the April deposits. So if they were to collect both of those together, the total deposits that are hanging out there would be There's other ways to do this, by the way. Got some weird kind of spacing going on here. What's 8,400 plus 35?
11,900.
Yeah. So this is really the total deposits that are out there for April. We have the March ones that'll be clearing in April at the bank. And then we also have the new deposits. So if we were to collect all of them, the bank should have 11,000. You know, these are the total deposits. Let's say total. How about that? So the question is, how much of the deposits in transit do we have? The bank collected 87. If they would have collected all of them, they would have had 11,900. But they only collected 8,700. So how many are still, the deposits are still out there?
So you're gonna take the 11,900 and subtract by 87.
Yep. Yeah, so we'll take the total. I don't know how I got the spacing here, but let me label these. Oops, these are deposits in transit. We do the same thing. For the I'll say. And so deposits, and then we have the bank deposits. Bank April deposits. Uh, 8,700. And so we're going to have deposits in April deposits in transit. There's other ways to do this, by the way. And if you do it a different way, that's fine.
So 3,200.
There's a weird spacing going on here. I'll go to here. Yeah, 3,200. Thank you. And then this will be deposits up and over here. Oops. We'll leave it at that. Okay, so we're gonna have 3,200 deposits in transit for that one. So this will be the April deposits in transit. Or as I like to call them, deposits in tra. Because I'm stylish, that's what all the cool people call it. All right, so now we're gonna do the same thing for the checks. So the outstanding checks, will make those green. So we had outstanding checks of 4,500. We wrote another 9,200 in checks. So if we were to collect, or if all the checks would have hit the bank, it would have been 13,700. Check that. All right, and do it down here, I guess. Actually, down here probably makes more sense to do it. So April, so with the bank April checks. 9,100.
$4,600.
4,600.
Mm-hmm.
Thank you. So this will be our April outstanding checks. Thinking that. I have no idea what I was thinking when I made this thing. I'll put it underneath. Hey, checks. Okay, so this is gonna be our outstanding checks for. Now, once we get this, these two, now it's not so bad. So let's see here, we got, I can put it on the other page. So outstanding, so deposits in transit was 3,200. Yeah, outstanding checks was 4,600. You know what, the more I look at this, I bet you I did it on this page, but I did it before. Tons of room here, nice and open. Sorry about that, guys. Okay, so create a bank reconciliation in good form. So basically it's the same thing we did on the other one. Except we're gonna have to add in these. Onto the book side. But for the bank side, we have the deposits in transit. And so let's see, the April, the bank 27,140. In the book. 3,800. And then on the book balance, we got this stuff. April note collected. Service charge and NSF, okay. 560. Okay, well, yeah, that's not gonna balance out. Oh, wait, maybe it will. And again, my overly generous number of lines here, I'm not sure. Back 740. Maybe 740, okay. Oops. these are the corrected balances, and those will be what, after you make the journal entries for these, that's what you'll have in your cash account. And notice that if you don't make those, you're gonna have, you know, a number of accounts, not just cash will be off, but other accounts will be off too. Question on that thing? Tell you what, let's save this one for next week. We'll do this one next week. On the exam, I hope I'm wrong, but on the exam, these are probably one of the most missed ones out of the reconciliation. Okay, what I like to do is move on to, let's go down to page 11. Actually, my page numbers might be messed up. Go down to this one. Bank reconciliation, cutoff bank statement example. Okay, so you're going to do this audit, and they tell you that the ABC Corporation pays employees on the 28th day of each month. Last day of payroll. The last payroll of the year was on 12/28/1921. 2021, I'm sorry. Got that wrong. All right, the payroll account is a separate bank account that's used for payroll. This is actually a good control. This one. For control, for control purposes. Reading is fundamental. For control purposes, the account is funded the exact amount payroll on the 28th for each month. So yeah, here's how this is a control. You know, I get my paycheck and it's for $600, and I don't think that's enough, so I put a 1 in front of it, $1,600, and I fudge the writing so it looks like $1,600, and I cash it. That account's going to get overdrawn. It's going to highlight that there's something wrong because you fund the payroll account for exactly what the payroll is. So if somebody alters their checks for somehow, or maybe even the bank makes an error, you know, somehow in cashing it, excuse me, that it'll catch it. Or I'll teach you guys how to do fraud. You get a stack of checks that are blank checks that they run through the system, and you decide you're going to do something bad and you're going to take one of those checks. You don't take the first one because the numbers will be off. So what you do is you go in the middle or in the bottom and take a check and fill it out and cash it. This control would catch that. There's an extra check coming in for some amount. It'll hit it, you know, so it's a control to fund the payroll account for exactly what the payroll is. And if for some reason there's an overdraft, then you know something's wrong. Okay. So that's it's a common control. Okay, looking at the bank reconciliation, I had the following outstanding checks as of $12/31. Looking at these outstanding checks, there's something that immediately should jump out at you.
The check that's written 12/14.
Yeah, that's not supposed to be there. They say up here, and this is probably something they told you, that we write the checks every, but obviously there's some kind of exception for that. Because when you look at this, there was a check written on the 14th. Now, there may have been a good reason for it, but that tells you that this control of writing them all on the same date may not be quite what it seems. And you'll find that a lot of times too in auditing, that you'll ask somebody something and they'll say, oh yeah, we make the check, and it isn't until later you figure out that they're not. And it's not that they're necessarily being fraudulent, it's just that, sometimes they think that's the way it is. Sometimes they don't know that it's not being done that way, and so it could be a communication thing, but I can't tell you how many times someone's told me something and you go look at it and go, well, that's not what they're doing at all. And by the way, your observation of what they're actually doing is much more persuasive than somebody telling you. So when someone tells you, that's something that needs to be verified before you rely on it. It doesn't matter who tells it to you. And you find that a lot of times the higher up they go, the less they know about what really happens. So, all right, so coming down here, it says what would be a concern. And so the first thing I'm gonna write down here is a check written on 12/14. Not 12/28. And you're gonna look into that and see why that is. But that certainly is a concern about the controls, is that the controls, at least the way that they were told to you, may not be exactly right. Okay, so these are the outstanding checks. Now, a cutoff bank statement, in this case, the cutoff bank statement is on the 8th. All of these, or most of them anyway, should be in that cutoff bank statement. There might be one or two that isn't, but for the most part, these checks should all be cashed. All right, so what we're going to do is kind of go down the list here, and you have the date that it was cleared here, and we're going to see, which ones of these have actually cleared the bank. All right, and I think I'll just do it. So the one written on the 14th is now cleared. The second one hasn't. 17, 19, 18, 94, I think it has 95, it has, okay, this one has. Seven has. '99 is cleared. Uh, 1900 is cleared. And 1903 is cleared. Okay, now this one that didn't clear on it was written on December 28th, and this is one on the 8th. It's possible there's some problem with that, but it's also possible that someone just hasn't cashed it. You may look into it and see why it hasn't cleared, depending on how often that happens. But this very well could be that someone just hasn't cashed it yet. Maybe they're on vacation, they didn't pick it up, or whatever happened. Okay, anything else here?
The gap in the check numbers.
Yeah, they're gonna be getting check number. Now remember, these are the ones that didn't clear. So it is possible, that the other one, for instance, between 1900 and 1903, so 17,901 and 17,902 cleared, if you cashed them right away in December. Whereas these are kind of like the people who took a little longer time to do it, and this one really took a long time to do it.
There's also on the issue side gaps in the check numbers between 1897 and 1899, and then 900 to 903 in their list of what they issued on the 28th. So
well, these are the outstanding checks. These are the checks that people didn't cash yet.
Oh, okay. Sorry, I thought they were.
No. It's an excellent question.
Check run.
It's an excellent question. Yeah, yeah, they should be serially, absolutely, serially numbered. And these are the checks that people didn't, for whatever reason, they didn't clear. But now you know, again, we have this odd duck here, this one that was on the 14th. Don't know why that was. Look into it. But there's also something else strange about this.
For the bottom section, the last 3 checks that are written.
Yeah. For these checks to clear, they almost certainly had to relate to the previous year. It's hard to believe someone would earn $3,427 in 2 days. Maybe, I don't know, maybe they did, but anyway, these down here may very well be payroll checks that belong in the previous period. It might be that these belong as some kind of salary expense or bonus expense or whatever they are. But these ones that have cleared that were not in this outstanding check amounts, those could also be partly something that they were obviously written by the end of the year. I mean, these were all written on the 20. You know, if these had been written on the 28th, they'd be included in these checks up here, right? If they had been, if these checks that cleared down here had been written, they would not have cleared because they cleared on January 2nd and 3rd. So they would be up here in the outstanding checks, but they weren't in the outstanding checks. So why were these 3 checks not in there? So these last 3 checks are a problem because the last 3 checks may very well relate to the previous year. Oops. And maybe they were bonuses or whatever they were. They could be other things besides payroll, but whatever they were, those 3 checks. Well, 31. So this is one of the reasons why we do this cutoff bank statement. And it could be like, well, we don't know, we don't know what the bonuses are until we figure out the income and then we pay out the bonuses. That's fine, but if the bonuses for 2021, you gotta make sure that the expenses in 2021. For the bonuses. So even if it was something along those lines, you may very well have to go and see where they actually recorded those. But anyway, this is why we do the cutoff bank statement. A lot of times, you can figure out a lot of things. This one may or may not be a problem. I actually worked with a woman at one place who she was very wealthy, from a very wealthy family, and she never picked up her check. And she would go 5 months and then pick up all 5 of them. But anyway, so it is possible that it's just someone didn't cash it. But these are some of the things that you'd look at. And again, one of these things too is, what people tell you is not necessarily what really happened. So this thing that they pay them all on the 28th may not be right. And we actually have evidence that there's something wrong here. Okay. Question on that? Okay, bank transfers. This is something that can, here's what bank transfers are. It's much less common, I think, today because we have so many electronic transfers that this is less of a problem, especially if they're doing electronic transfers. And also many banks require that all the accounts that all your banking goes through one bank. Oftentimes you get the smaller, medium-sized business, bank will give loans and have bank accounts with that. Part of the agreement will be, we have all of your accounts. So we're going to do your general account, your payroll account, all that. They all have to be done through us. We don't want you going over to 5 different banks and opening up accounts in them. So, and then of course, electronically, it's done can be done within seconds that both accounts are updated immediately. But here's what this comes down to. There's a float time that it takes between writing a check and it clearing the bank. So let's say that I had 2 different banks. Okay, and I want to make it look like I have more cash than I really have. So I write a check from one bank account to the other, and I make the deposit. So immediately it looks like there's a deposit in that account. Now, it might not clear. The bank that is being written on may not know about it for a day or 2, or depending where it's at, even a few days. So that float time is the thing. I can make it look like I got more cash in that account because I deposit the check into a different, from one bank to another. And it's not going to come out of the other account for a few days. So that's the whole idea behind what they call kiting. There's other ways to do it that you can make it look like you have less cash than you have. But kiting is a way of making it look like you have more cash than you really have. And so that's what we're going to look at next, is how do you make, you have to know how to do the fraud so that you can spot the fraud. So especially if someone is doing bank transfers. And by the way, we just, as we did with the payroll account, we know that some bank transfers are good, and they're even, they help controls, things like payroll. It's also possible, especially if they're writing checks, that those bank transfers are can be used fraudulently to make it look like you have more cash than you really have. So that's kind of what we're looking at, is that, and it has to do with that discrepancy in time between the receiving bank and the dispersing bank. The receiving bank will get it and then put it through, right away. It might not get to the receiving bank or the payout bank, the dispersing bank, for a day or 2. Okay. So kiting. Oh, I guess we only need one, the check, what they call float. Right, I mean, there's a better way to write it. More cash than we do have. Me bad English? That's impossible. So it's to make it look like they might have more money than they really have. So they're using the float. And by the way, so a lot of times you make this deposit, and if you don't put anything else with it, it might be assumed that this is, say, a customer deposit. Maybe this is a sale. And another thing about this is, if the auditor isn't aware of what's going on, they say, well, what do you mean this isn't a sale? It's cash. It's right there in the bank. We made the sale. The cash is in the bank. It's a sale. If the auditor didn't know to look for that check actually came out of one of the other bank accounts that the client has. So, there's another dimension to this, that because it's dealing in cash, it actually carries more credit. It can carry more credibility if you're not aware of what kiting is. Okay, now, so here's the criteria for a valid transfer. The journal entry must be made on the same date or before. No, the deposit is received by the receiving bank. I'll show you what I mean in a second here. So the journal entry must be made on the same date or before, the deposit is received by the receiving bank. So the journal entry must be made beforehand or at the same time at the receiving bank. If it's made later, it's gonna be a problem. And secondly, the journal entry for the deposit and receipt must be made on the same date. So the journal entry has to be made at the same time as the deposit or ahead of time. It also must be made at the same time. So the receipt and deposit must be made on the same date. Okay, so this first one here is kind of your typical transfer. Oops. So the receiving bank received it on 12/31. And the dispersing bank didn't know about it till the 4th, by the time it got through, the deposit and all that other stuff. They didn't know about it till the 4th. And this is not, there's nothing wrong with this. This is kind of how it goes, right? You make the deposit, it goes in immediately, it's more likely to be counted earlier, and then the disbursement will be made. Now, if it's the same bank, it'll probably just come out of they'll probably clear it internally. But if it's two different banks, it may be. Okay, so coming down here to the journal entry, and let's look at our criteria. Was it made on the same date or before?
Yeah.
Yep. Yeah, made on it was made on 12/31, so this is fine. And was the deposit and receipt made on the same date? Yeah. Here's the cash going into bank A, and here's the cash coming out of bank B. So they're made on the same date, and they're made on the same time, or before. In this case, they have to say at the time of the deposit. So is there a problem? Nope. That's fine. So, notice that their cash account isn't any higher than it should be. You put cash in one account, cash account, took it out of another cash account. And this is a normal transfer. So this would be normal. Okay, continue. I put continue like we just all stop. Anyway, so let's go to the second one here. Okay, second one. I'm gonna copy my rules down here. Okay. So let's see here. We have this was shown as received on 1/2, dispersed on 1/4. The journal entry was made on 12/31. Is this okay or not okay?
No, okay.
Well, let's take a look at the rules. So the journal entry must be made to the same date or before the deposit. So this was made before, and maybe we put it on the 31st. Maybe it didn't clear until the 2nd that they added to our account, and then it didn't show up in the dispersing. And the journal entry for the deposit and receipt must be made at the same date. So is this one okay or not okay?
It's okay.
It's okay. Problem with this one? No. It follows both the rules, and our cash is not being overstated. It's one account's going up, one account's going down. For whatever reason, there was a delay in receiving it, and there's always gonna be a delay in dispersing it. So they're not a problem. Let's have some fraud. Okay, let's go to number 3. There is a problem with number 3. What is it?
The journal entry was made after the date that the deposit was done.
Yep. This is the problem. Notice this here, this bank statement. They received the cash on 12/31. Here's what this is going to look like. Magically, $12,000 was added to Bank A. When we get the bank statement, it's going to have magically $12,000 additional amount to it. It could be covering for a loss, it could be covering for a theft, it could be whatever it is. The bank statement from Bank A is going to be $12,000 overstated. And remember, there's no journal entry for it until the next year. So it is going to look like magically $12,000 showed up in Bank A. So this is why we have to have it made on the same date or before. Before is fine too. But yeah, so this is kind of what kiting is. This is making it look like Bank A has more cash than they really have. So the cash will be overstated by $12,000 in 2020. Okay. Number 4. Number 4 is kind of an obvious one. What's the problem with number 4?
Ugh.
Everything. The problem is, first of all, the entries are not both made before the deposit, so the first rule is gone. But also, they're made on 2 different dates, and this is also a classic kiting ruse, where you put the check in and count it as revenue to make yourself look more profitable than you really are. And then when it clears, you make another journal entry saying, oh, well, that was an expense for whatever, you know, rent expense, whatever expense, make up something. So this is to show revenue in 2021, and then the expense goes into the next year, and you'll figure out something next year to, you win the lottery next year, and then you can fix that. But yeah, so this is the receipt and disbursement are not going in at the same date. This one actually violates both the rules because of this. So there's a problem with this. Oh wait, I say there is a problem with this one up here. I'm sorry. I'm not answering these like I should be. Yes, what's the problem with this one up here? It's the entry was made after. So number 3 entry was made after the, let me bold this. So 3 entry is problem with it, yes, entry was made after the transfer. This one entry was made after the transfer and space. So first entry is made after the transfer, and second of all, oops. Receipt. And disbursement. Disbursement needs an R in case you're wondering. Receipt and disbursement. Receipt and disbursement made on 2 different dates. And yes, there's a problem with it. And this is a classic. This is a classic, someone trying to, meet sales goals or whatever it is. But I had another one. Oh, I took it out. Okay, that's fine. There is a way that you can actually make it look like you have less cash than you have. It's technically not kiting. Kiting is making it look like you have more cash than you have. But you can also manipulate it, and basically you're manipulating it by making, counting the expense in one year and then picking up the receipt in another. Okay, well, hey, we got through it. All right, well, let's go ahead and take a break. And we come back, we'll look at the we'll start in on the sampling. So say be back at 7:12. Okay. Here, I'll put this one back up in case it. Okay, classical sampling. I did a terrible thing to you guys. I showed you how to pick a random sample. They generally don't do that on the CPA exam. They don't have you picking a random sample. Lights out here like a vampire. They will generally give it to you similar to what we have from number 2 on. If they do have you do any calculations, yeah, they'll kind of look like this. You generally don't have to pick a sample like we did here. But it's good to know though how to do that. Okay. Oh, I gave this as homework. Let's see here. Did you guys give this a shot?
I finished the whole thing.
Okay.
I
Yeah,
finished the whole thing too.
Okay. Now let's take a look at it. So this is an odd one in that let's see, well here I'll just do the calculation over here. So the audit value was 1,200. Divided by 5 equals 240.
Yeah.
Yes.
Oh. Okay, so the weird thing is, as you guys have figured out, I'm sure, is that the mean per unit one oops. Over 10,000. So this would be the projected value. $2,400,000. Now, projected misstatement would be what?
100,000.
100,000, and it would be a overstatement or understatement?
Overstated.
Overstated.
Yeah. And we're going to find that this is a little bit unusual in this one because we go to these other ones. The book average is 220.
Yes.
And so this will really give you kind of a stark look at the difference between these methods and what they can give you. I think that's right. Might be up by $1 there.
That's what I got. I rounded up.
Okay. And so this is the projected value. And so this is kind of strange because this one will give you a projected misstatement of
227,272. What? 273.
yep. And will it be overstated or understated?
I have understated. I have understated.
Yeah, that's the really kind of weird thing here. And this can happen. And it happens basically because this one only uses the audit average. Whereas this one, the other two use both of them. You know, there is a contrast between them basically. Whereas this one, just if it's just at 240, you know, they're the same numbers. You're using the exact same data. But mean per unit will give you an understatement, and ratio will give you an overstatement. Difference estimation will also give you an overstatement. You get to figure that out. All right, so difference estimation. This is a little bit strange because it's the whole idea behind it is that everything will be off by the same amount. So in this case, the difference is 20. And so what we're going to say is, okay, every single thing that we have is off by $20. The 200,000.
20,000.
20,000? The 1,000? What do I have here?
200,000.
Okay. Yeah, we're saying each one is off by the same amount, 20. So this be 200,000. So this is the projected misstatement. So the question becomes, oops, is it overstated or understated? Well, the audit average is higher than the book. So we would be saying that they have to add $20 to each item to get to the right amount. So is this going to be overstated or understated? This is a think about.
It's understated.
Yep. Yeah, we're saying that each one is understated by $20. You know, this is an understatement. There, each one's understated by $20. We have to add 20. So this would be the projected value would then be what, 2,700,000. Oops, too many there. Still too many. Yeah. Okay. Okay, I think number 4 is that the last one. I think I'll let. Oh, I got 5. How many of these do I have? I'm sorry. I tell you what, we'll do number 4 together, and then I'll let you do 5 on your own. Then we'll just talk quickly about the different when to use them, and they'll round up this. This shouldn't take more than 5 minutes. Okay, and this is a very common way you'll see it on the CPA exam. where they don't give you a list of things like this. Where they just say, you know, that the total audit value of the sample was this is the sample size, the total book value of the sample is this. What are the, you know, and a lot of times they'll say, what's the, you know, they'll be more specific. What's the projected misstatement using ratio estimation? You know, it'll be something like that. A lot of times it'll be very specific as far as what they want, but if you know how to do both of them, you should be fine. Okay. So we have a sample size of 60. And these are the values, so we're gonna take these and divide by 60. And again, this is much more common. You'll see it listed this way on the CPA exam than you would. And I know you guys probably get sick of me talking about the CPA exam, but that's just kind of a lot of what this relates to. A lot of auditing is the CPA stuff. And by the way, you know, they're like I was not a CPA firm. I was a internal auditor, and you do a lot of the same stuff. It's not, you know, it's not that it's only for CPAs. And also you'll be working with CPAs a lot if you're an internal auditor. I worked a lot with the actually both. I worked for US Steel and for Navistar, and both of them used Deloitte at the time. I don't know if they still do, but I used to work with Deloitte people a lot. Okay, so audit average. Oops. Okay. So mean per unit, and by the way, at some point, just try to get used to, you know, kind of reasoning through what it's actually asking for. You know, mean per unit, mean is just average. Whose average do we use? The audit average. It's, you know, the audit is the one that's the more persuasive. The stuff that you do yourself is more persuasive than what somebody else hands you. So when you do this is the most persuasive number up there, is the audit average of 30. So when you do mean per unit, you say, okay, we got $30 per unit, then everything here should be $30 per unit. Sales. Okay, so sales. So this is every sale should be $30. There's 20,000 sales. $600,000.
Yeah.
By the way, if I go through here, if I'm going too fast, and you don't see where, let me know. You can put it in the chat. You can do a private chat. That's fine. No, slow down. And it's hard to know if you're going too fast or too slow. Okay. I think I'll go ahead and. They gave us a total book value, sales book value of 700,000. And so we have a projected misstatement of $100,000. Over understated. Or understated, I should say.
Overstated.
Yep. Ratio estimation in to me is probably the most useful of them. I think when I was doing auditing, I may have used the mean per unit on a few of them, but things I did, but for most of them, they were ratio estimation. A lot of financial stuff was ratio estimation. I think for some inventory, I may have used mean per unit for the manufacturing stuff, but most of it was ratio. And we do it alphabetically audit. Backwards. $636,364, 363 is fine. The dollar wouldn't matter. So that is by 63 something. 63, 9, 36.
636.
636. Thank you. That's right. Yes. And so this would be the corrected misstatement. And again, everyone should get the same number on this. Whether this 63,636 is material is a judgment call, and the CPA exam has not tested on judgment. So, all right. Okay, difference estimation. And ratio estimation says that everything is up by the ratio. Difference estimation says everything's up by the same amount. And so this case is $3. Now, is this gonna be an overstatement or understatement?
Gonna be overstated.
Yeah, let's see, we're saying it's 30, so we're saying that they've overstated it by $3 each. All right, and we're gonna multiply it by 20,000, so we're gonna say everything here is overstated by. So the overstatement is 60,000. And this is the projected misstatement. This is kind of the weird one in that you get the projected misstatement first. Let's try that again. No, control. And this is an overstatement. So you got to kind of back into this one here. All right, so the projected misstatement is 60,000. So what is that? 540? No,
6,
yeah,
640.
you're right.
640.
So 640,000 would be our projected value. All right. Okay, and I think we talked about this before, but I'm gonna skip this one. I'll tell you what, you can do this one and turn it in. It's very similar to the one we just did. And you'll notice that these are nice big round numbers. I think that these are actual, I think the numbers even are actually from the CPA exams. When I took the CPA exam, you couldn't use calculators, so you had these big round numbers for everything. And you knew that if you did something, if you came up with like 5.327, well, you knew you did it wrong because they never give you the number. Okay, mean per unit. Appropriate when. The items in the sample have a similar value. So when all the items are about the same value, mean per unit is a good one. So if everything is around, $10, $11 or something like that, it's a good one to use, mean per unit. Ratio estimation, which I don't know this for a fact, but I think it's probably the most useful one, is appropriate when. I shouldn't say errors, I should say misstatements. Lost my. There we go. Well, misstatements are relative in size. To the value of the item. In other words, large items will have larger misstatements. Small value items have small misstatements. And that, I think, is pretty much, is most things. You know, $5 account's not gonna be off by 500,000. $5 million account might be. Okay. Difference estimation,
Professor, can you go back?
yeah. Here, let me, actually, I don't know why I'm, I'm very generous with the space on this handout for some reason.
Thank you.
You're welcome. And again, the ratio estimation one, I think for financial stuff is probably the most appropriate. I think I use mean per unit stuff for some of the manufacturing stuff that was all, it was all similar valued. And you're really looking at quantities times a similar value. I don't think I ever used difference estimation, but it could come about. It's when misstatements. It's when misstatements are like be for the exact amount regardless of the value of the items. So in other words, that the misstatements will be the same. If it's a $5 item, the misstatement will be the same as if it's a $5 million item. It could be that there's, let's say handling charges or some weird kind of a thing that gets missed a lot. That is the common thing that it's misstated by. You have a difference estimation. I gotta think that it's less likely though. Yeah. I guess it could be that if there are things that are something is unique that causes the value, this is completely but like a convertible versus a hardtop car. A convertible car would have the difference is probably whatever it is, $3,000, whatever. So that if there was a mistake or whatever, that you could add it. That's probably a bad example, but there'd be some kind of a fixed amount that they would be off by. So ratio estimation is big stuff, big misstatements. Difference estimation is doesn't matter what size, it's the same misstatement. Okay. So I'll tell you what, so go ahead and do this one. You guys can do this one here. You probably already have it done. Do this one for homework and you can turn it in. You can also wait and turn it in next week too. I'll go ahead and do it before class and put it up. If you want to check before you turn it in. But yeah, and this is again similar to what we have for number 4, and this is probably the most common way you see it on the CPA. Number 5. So 2 through, is it 2 through 5? Yeah. Oh no, 1 through 5. Okay. And let me just check and make sure that I have the drop for those. That's not it. I think it is. Yeah. Okay. And so then next week, so go ahead and finish up well, you can turn both of them in, right? We finished up both of them. So you turn up both the basic classical sampling and the chapter 10 handout. And next week we'll do some chapter 10 problems, and I might do a little bit more on the lapping one, just because that's the one that tends to throw people. The lapping and the bank reconciliation. I may try to do the bank reconciliation also for the chapter 10 handout. So see if you can do that one. And if you're confident you want to turn them in, you can. If you want to wait till next week, I'll put both those up. I'll put the bank confirmation, the second one that we didn't do, the third one we didn't do. And then number 5 for the classical sampling. If you want to wait till if you want to wait till next week just to make sure you got it right, you can do that. But then we'll be done with that. So next week we'll have we'll probably do some multiple choice questions for chapter 10. And then I'll send out the chapter 10 exam, and we'll also start in on chapter 11, and we might start a new sampling. No, it's not. It's going to call that anymore. Monetary unit sampling. We'll maybe start a monetary unit sampling next week. Okay, any questions? All right. Well, have a good night, and I'll see you in a week.
All right, thank you.
Thanks. Have a good night, Professor.
Good night.
Yeah.
Good night. Thank you.
Good night. Have a good weekend.